It is 11:47 p.m. in San Francisco on January 20th, 2025. Inside a glass tower overlooking the bay, a portfolio manager is staring at his terminal. He's been holding NVIDIA stock for 3 years and making a fortune. Then a single notification appears. By the time the markets open the next morning, NVIDIA will lose $593 billion in market capitalization, the largest single-day destruction of wealth in the history of the stock market. The crash was triggered by a Chinese startup almost nobody had heard of. DeepSeek had just published an artificial intelligence model that completely matched the reasoning capabilities of OpenAI's GPT-4. They didn't achieve this with billions of dollars or a decade of research. They trained their model for exactly $5.57 million. This animated chart compares that tiny $5.5 million Chinese training budget against the $448 billion that 5 American tech companies spent on AI infrastructure in 2025 alone. Amazon, Microsoft, Alphabet, Meta, and Oracle poured nearly $500 billion into data centers and GPUs in a single year. The enormous gap between those two numbers forces a very uncomfortable question. Are American companies building the most valuable computational infrastructure in history, or are they blindly financing the most expensive debt-leveraged bubble we have ever seen? To answer that, we have to look at how this physical American infrastructure is actually being bought. For the first time, big tech expansion is being funded by corporate debt rather than free cash flow. In 2025, major infrastructure companies, often called hyperscalers, spent $342 billion on capital expenditures, but only generated $306 billion in free cash flow. They spent more than they earned. This flow of capital visualization shows where earnings reports get risky. Microsoft invests $13 billion into OpenAI, but OpenAI commits to spending billions back on Microsoft's Azure servers. The money flows back, artificially inflating reported cloud revenue. To make their balance sheets look even better, these companies are quietly stretching out their accounting math. Historically, standard practice was to write off or depreciate a server over 3 years. Now, Alphabet, Meta, and Microsoft have suddenly extended that estimated useful life to up to 6 years, dropping billions in annual expenses off their ledgers. The problem is that silicon does not care about accounting schedules. Artificial intelligence training pushes processors to run at intense utilization rates. This extreme thermal and electrical stress physically degrades the chips, pushing them to fail or become economically obsolete within 1 to 3 years. When you combine hardware that burns out in 2 years with debt that takes a decade to pay off, you realize that explosive tech earnings are currently masking billions in stranded assets and artificial demand. While American firms were spending themselves into a corner, China faced a completely different reality. Starting in 2022, strict U.S. export controls blocked Chinese access to top-tier NVIDIA chips. The explicit goal was to starve them of computational power. Instead of giving up, Chinese engineers adapted. This neural network visualization demonstrates a technique called mixture of experts. Instead of activating the entire massive web of processors for every single question, like traditional American models do, this architecture only triggers the specific subnetworks needed for that exact prompt. Because they activate a fraction of the hardware, Chinese developers can generate 1 million output tokens for about $1.10. Generating that same output on an American model costs around $10. When a software company in Indonesia or Nigeria decides which platform to build on, a 90% discount dictates the entire decision. Chinese AI models have already captured over 20% market penetration in 11 different countries. The irony is severe. By restricting access to raw hardware, the U.S. forced China to innovate under constraint, resulting in highly efficient models that are now collapsing the global price of artificial intelligence tokens. If this combination of massive debt and plunging prices feels familiar, it is because we have lived through this exact sequence of events before. In the late 1990s, convinced that internet usage would grow infinitely, telecommunications companies borrowed heavily to lay millions of miles of fiber optic cable. But supply quickly outpaced actual demand. Between 2000 and 2004, the price of bandwidth crashed by 90%, destroying huge infrastructure companies like WorldCom, which also used creative accounting to hide its losses. Today, the price of AI tokens is plummeting at a rate of roughly 10x per year. We are seeing the exact same dynamic of debt-fueled physical expansion colliding with aggressive price deflation. There is one major distinction. WorldCom only sold bandwidth. Even if the massive data centers built by Amazon, Google, and Meta fail to turn a profit, those giants still rely on bulletproof core businesses like search, retail, and enterprise software to shield them from total bankruptcy. The most important lesson from the 1990s is what happened next. The telecom bust bankrupted the builders, but it left behind a massive oversupply of cheap, unused fiber optics. That nearly free bandwidth allowed entirely new platforms like Netflix and YouTube to exist. The exact same mechanism is at work right now. Between the hundreds of billions in American capital expenditure and the relentless efficiency of Chinese algorithms, the cost of raw intelligence is being permanently driven toward zero. The greatest wealth in this transition will not be captured by the companies hoarding chips and trying to pay off data centers today. The real winners are the second movers, the enterprises in healthcare, logistics, and finance that are waiting on the sidelines. When intelligence becomes hyper-cheap and abundant, they will use it to completely rebuild the global economy from the ground up.